Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
Okay, so today we're going to talk about Blackstone REIT getting a $4 billion investment, $4 billion with a B, from the University of California. It's basically their retirement system.
So very sexy, big numbers. We're going to talk about that. But first, if you're new to the channel, please subscribe, hit the notification bell, like the video, share the video, leave us a comment, tell us where you're from, and let's go.
Okay, so we're going to talk about the article, but basically there's something super important in here that we want to sort of start off at the beginning with. They believe in real estate long-term as an investment vehicle. And we're going to talk.
Who are they?
University of California.
Okay.
So they see something long-term, obviously, and we're going to talk about the numbers involved in this, the returns they're getting on this REIT, and then how REITs have maybe changed over time and stuff.
Okay. So, I think it's interesting. I was reading an article today because clearly I have no life. And
At work, you're at work reading an article?
Yes. So I was reading an article, and it was talking about that Jay Powell is telling Wall Street, keep your mitts off, don't help me, I've got this on my own. So what he was talking about was investors on Wall Street. He was saying, hey, don't run up the stock market because that's not helping me deal with inflation, and it's just going to cause more hikes in interest rates and maybe higher than what we want to go. So I thought that was really interesting, particularly when we frame it against this huge investment, which is essentially in the stock market. So tell us about REITs and how they are positioned in the stock market.
Okay, so the REIT, of course, REIT's a real estate investment trust, and the idea behind a REIT is that you take institutional money to invest in large real estate projects. So the way these things started were, so a lot of you know, like the 80s and the 90s were the decades of the malls, right? Mm-hmm. These massive malls that were built had a really super high return. They were great investment vehicles. But you couldn't just go get mom and pop investors, angel investors and VC funds wouldn't touch this. You had to go get money. So they created these things called real estate investment trust. And basically what it was is you just put a ton of institutional money into a pool and then they bought all these things. So I think even to this day, well over 50% of all malls in the US were all REITs. They were in REITs. So this is what's interesting, and this is why we're talking about this, where we generally talk about residential. This has shifted. Mm-hmm. The REITs have grown substantially in real estate. They still have a lot of those assets. Those are not a very good performing class for them. Mm-hmm. All the old stuff, so shopping malls, centers like industrial centers are not necessarily, maybe massive buildings in cities, mm-hmm. things like that. Where they've been killing it is in real estate, like
residential
real estate, like right. Single family homes. Mm-hmm. So what happened was about a little over a decade ago, they all decided to start turning these things, accumulating large amounts of single family homes. Mm-hmm. And I'm going to read this quote from the article. Blackstone REIT reported holding nearly $118 billion in real estate investments as of November 30th, with approximately 80%. So 80%, that's basically about $100 billion, a little less than $100 billion, concentrated in rental housing and industrial properties, sectors where fundamentals are historically strong, and 71% concentrated in the Sun Belt, which is experiencing higher job and population growth than the national average. Juana, tell them what the Sun Belt is.
Where we live, not just us. But so you've got Las Vegas, Arizona, you've got Florida, Texas, you've got the whole southern part of the U.S.
Yeah. So there's a lot of people. But, right. If you look at the U.S., you have a ton of people in the South, right. Southern parts, because of the weather's there and there's companies there.
Well, and there's also been a lot of recent migration to the South, particularly Texas yep. and Florida. Mm-hmm. And, we've talked about some previous videos that when these companies go and they look for markets where they want to purchase, they're looking at several different fundamentals. They're looking at potential for appreciation. Okay. They're looking at areas that are growing, that are attracting a certain number of new residents, and not only by a certain number, but a certain type of new resident. And what I mean by that is maybe they're looking for a certain income level because they want to invest in properties that have that sweet spot of appreciation for them and for rent. So that they're taking a lot of different things into consideration when they're looking at what markets to to purchase in. So they've done this in Atlanta. I mean, Atlanta's famous for this.
Yeah, Georgia.
And Georgia in general is famous for this because Georgia's seen a lot of influx of people. Same thing with Florida, big influx of people. So you're looking at these markets, and they've really gone after these markets and done a lot of purchasing there. And to Todd's point, they have spent a lot of money, and because they own so much property, and I've said this before, because they own so much property, and this property is free and clear, it's not subject to the whims of what's happening in with interest rates. Then this provides a lot of support, because that means that inventory is not going to be coming on the market anytime soon.
Yep.
So that's providing a lot of support in the way of not bringing inventory to market. So supply and demand, that means that whatever demand there is less supply, because these homes are not coming on the market.
The other interesting thing, quote from the article, Blackstone REIT Class 1 shares have generated a 12.7% annualized net return since inception 6 years ago, according to Blackstone Group. This is only one of a number of companies that have been buying. There's other funds, hedge funds, Wall Street firms and things that are buying. But this 12% annualized net return number is very interesting, because if you can get a 12% capitalization rate on a property, which is your return, that's really good. You could get this in like 09 and 10 and even 11 a little bit, because homes were so cheap and rents hadn't fallen that much, but home prices had fallen so much. You pretty much, and I remember we had an investor come in and bought 50 houses, and every single house, the rule was they had to get over 1% a month of so if the house was an $80,000 house, we had to get at least $800 a month in rent out of it, gross, right? And so that's 12% per year, and that was the rule. So we were able to get 50 houses where we could buy it for $90,000 to get $1,000 a month rent out of it. And then here's the other thing to think about. You have an acquisition price, but then you have rents appreciating. And that's sort of where the magic is. And that's why these funds are doing so well. They acquired these properties so cheaply a long time ago, and now they're just generating billions of dollars in cash, because it didn't take them that much cash to acquire it, but now it's such a valuable fund. And it's backed by homes all over the place. So they're sort of diverse. Yes, there are a lot of single-family homes, some industrial properties, but it's predominantly single-family homes. Want to talk about the idea of what does this mean for like an individual investor? Like, how do you compete with one of these large firms that has like a whole team of people that are doing nothing but running analytics? And when they say the zip code you're in, Mr. Small Investor, we've targeted that zip code as having future potential, and they come in there, how does that hurt like an individual investor?
So it does hurt them, because an individual investor does not have the brute force of those analytics.
Yep.
Okay. But the individual investor has something that maybe these bigger firms do not have. And that is intimate market knowledge, because this is where we live. This is our home, and I think we do have a better understanding sometimes, not always, but a better understanding sometimes of the market. And I think there are times when people would rather deal with the individual investor versus the nameless, faceless corporation. It happens where we do have sellers who say, I want to sell to a person, I don't want to sell to a company. And it happens.
Okay, here's my prediction. Over the next few years, home prices will moderate, potentially decline a little bit, but these funds will keep buying. Inventory will stay low, and that will certainly help, moderate home prices. But the other thing it'll do is it'll make it real estate a potential better investment long term if you already hold assets, to probably not just dump them and maybe just sit on them and let rent continue to, go up while you hold your acquisition costs and interest rate don't change.
Right. So, it doesn't mean that these institutional investors are not going to shed underperforming assets. Of course they will, because that's part of their business. But the idea that they would shed them in mass, particularly in a particular market, that's unlikely, because they certainly would not want to sell two houses side by side and have a downward spiral on the price for each of them. That hurts them. That doesn't make any sense. So I think when they do look at lesser performing assets, I think that they're going to look at them maybe in several markets, or certainly not in the same neighborhoods, and shed those individually, however that they choose to do them. Or we've talked about this before, they will go ahead and bundle some and sell them to some other fund who is interested in purchasing those assets.
Anyway, we thought this was interesting data. $4 billion lets some existing investors leave the REIT. It gives them new money to sort of keep the thing going. There's a ton of, 118 billion is a lot of money. I expect this to be an asset class that grows over time, and they've really taken over from what used to be the mom and pops owning real estate.
Absolutely. So if you found the video interesting, entertaining, if you like charts, if you are interested in watching more of our videos, please subscribe, hit the notification bell, like the video, share the video, and leave us a comment. Tell us what you think. Use your crystal ball and tell us what you think that will become of these institutional investors. We want to hear from you. We'll see you on the next video. Bye.
Bye.